Rob, it's time to eat crow. A couple of years ago, when Warren Buffett and 3G bought Heinz, you said they paid too much. Now they seem to be making a lot of money. What's happened?
Yes, I'm eating a massive portion of crow. It's like the 4 and 20 blackbirds, except it's 4 and 20 crows baked into a pie for Armstrong. I thought when they bought Heinz, Buffett and 3G paid a very high multiple of earnings for a company that was not growing, and I just didn't see how they were going to get that money back with a big return. And the answer turns out to have three parts. A little bit of valuation improvement, a lot of leverage, and a lot of cost cuts. So the market has gone up in the meantime, which helps the valuation of their equity holding in the company. Two, they piled a lot of debt on the company, which means whatever increase in the value of the company they get more of that to the equity as the debt stays the same level. And finally, they cut an incredible amount of costs out of this company. So the EBITDA profit of this company increased by $700 million in the 2 years that they owned it. So from like 2.1 to 2.8 billion dollars. So that's a huge increase.
It is a huge increase. How did they do that?
Well, they started by firing 20% of the people who work at Heinz, which is an effective way to cut costs in any company. They close factories, and 3G is famous for sort of zero-cost budgeting. Their basic assumption is they're going to not give every department any money at the new year, and they have to fight for it. So they've brought a tremendous amount of cost out of the business, and that is the primary driver in the increase in value and therefore the increase in paper returns that Buffett and 3G have.
But is that sustainable?
Well, this is sort of the interesting question. Over the 2 years that 3G has owned Heinz, its sales have actually fallen 5%, which you would sort of expect when you're cutting costs that radically. It's going to be hard to sell more stuff. And the question is, how long does that pattern persist? And because when this new Heinz plus Kraft company goes onto the market, they've got to grow sales if they're going to, the valuation of the company is going to, or at least hold sales flat if the valuation of the company is going to be sustained. So it's not over yet for Buffett and 3G. The new publicly traded Kraft plus Heinz company has to do well in the market.
It's got to sell a lot of cheese, a lot of beans. We'll see how it goes.
That's right.